we will look at statistics. We're going to do a backtest, so a simulation of buying and selling the one token. And we're trying to find out what's a strategy that works well for the one token. So without further ado, let's jump right in. Hi, timing the one token does make sense, right? We've got quite a bit of volatility here. Sometimes one goes down by more than 60%. We also see this here in the bear market of 2021. So there is quite a bit of volatility, and we can still take advantage of this long-term upwards trend without necessarily being in the market when the price dumps that much. We simply have to find a way to somewhat time this, right? To buy whenever the price tends to increase, to sell whenever the price tends to decline. Now, the answer to this isn't that obvious, right? Otherwise, we would all be rich. But we can use some kind of backtesting tool. We can simulate buying and selling to time the market. And a pretty straightforward way, this is what I like doing on this channel, is to use moving averages. So you can use a simple moving average, for example, or an exponential one. In this case, we are plotting the simple moving average, and we are now looking at the day end prices. So we can increase this duration, and we could say, okay, we want to be in the market whenever the price is above the moving average. So we take advantage of all of this price movement, but we are outside of the market when the price is below the moving average, right? So we avoid this kind of a drop here. So you could do this. Now the question is, when doing this, what's the ideal duration of the moving average? Should we take the 50-day? Should we take maybe a shorter period? And then let's say with the 20-day, we would exit the market here earlier when the price movement turns around, right? Would also enter earlier when the price momentum is positive. So what's the ideal duration? Because when we go too short on this, right? Let's say we take the 7-day simple moving average, then suddenly you've got a lot of failed signals. You've got a lot of noise around the moving average. You get in and out of the price, in and out of the asset all the time, which then means you generate a lot of cost, but it also means you generate a lot of bad trades, right? You would buy, for example, here on the 9th of May 2021, just in order to then sell 1 day later. And the way this is set up is simply I look at the price at UTC midnight, right? So I only look at this once per day. I do not care about the price crossing this moving average within the day, right? Because then you would really trade way too often. So we only look at this once per day and then decide, are we buying, are we selling? And so what is then the perfect duration for timing the Harmony One token? That's the question, and that's where I've done the backtest. This is the result of the backtest. So I've backtested the simple moving average. I've also backtested the exponential moving average, meaning a moving average that takes a bit more weight on the recent data, so it has a recency bias. I've also backtested the double exponential moving average. Now, this is the result of the SMA, EMA, and buying and holding. This is with the double exponential. We can actually forget about the double exponential. It doesn't perform well. But before we jump into this result, let me first show you how this actually looks in a performance line. So this is how this looks like in practice. So there's a bit of a different color coding, but again, we've got here our moving average, this time in black. And when the price here in white is below the black line, right, below the simple moving average, then our portfolio line here in green is completely flat. So we are 100% in cash. Once the price goes above the moving average, we follow the price movements, right, up until the price close. Then we are again below the moving average. We're just in cash. Here we've got a failed signal, right? This is one of those failed signals. So we crash a little bit, we go above the moving average, and so we follow the price movements again. So that's the idea. We only follow the price movements whenever the asset is above the moving average, and we can backtest this over long periods of time with different moving average durations. And here on the x-axis, we've now got the average duration. So from 1 day, which is just looking at yesterday's price, all the way to 52 days. So a bit more than 1.5 months of a moving average duration. And on the y-axis, we've got the annualized performance. In black, we've got a reference line for buying and holding. Okay, so if you just bought and held the one token, Harmony One, over this entire period, which is, by the way, starting on the 1st of June 2019 all the way to today, the 8th of April 2022. So if you just bought and held Harmony One, you would have gotten 140% per annum. But if you traded according to that strategy, for most of the moving average durations, you would have outperformed buying and holding. So you just have to be above, say, the 18-day or so, and you would buy whenever we are above and sell whenever we are below. You would outperform just buying and holding. And so the best of the simple moving averages is the 35-day. And a pretty good exponential moving average is the 26-day. So when we look at this, the 35-day SMA, this is how that looks like on a linear scale over this entire period. Okay, so linear scale meaning we are here 100K up with each of those horizontal lines. Now we can also look at this on a linear scale, and that's how that then looks like. Okay, so we basically get spared from these crashes. This here was the Corona crash. We get spared from all of this, and thus we can outperform. Now, an alternative way to do this is not just to be completely in cash when we are below this moving average, but to actually bet on falling prices. And so we can also do that. So let's turn falling price shorting on. This is how that then looks like. Okay, so when we now fall down here, right, when we've got the Corona crash, we bet on falling prices, we would have made money. And this is a pretty consistent outperformance versus buying and holding, right? And on a linear scale, this looks really massive. This is assuming a starting capital of 10,000 US, right? So this would now have grown to almost 2.5 million by the time of this recording. So that's that strategy with the exponential moving average. The outperformance isn't that massive, but it's still there. So no bad result either. Also the overall volatility, right, from like the top to the bottom, like the drawdown, the maximum drawdown isn't as massive. So those are the moving averages that make sense to look at. Now we can further refine this, right? We can, for example, let's maybe plot this now. And let's plot the 35 SMA and the 26 EMA, 35 over here, 26 over here. So when we plot this, we can still somewhat improve this, because let's scroll in over here during this day here, right? On the 29th of September 2021, we would have sold, right? We went below both of those moving averages, but only barely. So we would have sold on that day just in order to buy back in higher on the next day. So maybe there's a way to somehow put a buffer around this to only trade when we are, let's say, 10% above or 10% below, and completely ignore all the signals that happen when we are very close to the moving average. So maybe this way we can avoid additional trading fees. We can avoid these bad signals. The trading fees, by the way, that I simulated this with is 0.1% for each buy and for each sell. So that's the Binance trading fees. So maybe we can trade a little less and get a bit more performance by including such a buffer. The question then is, what's the ideal buffer, right? Should we take maybe a buffer of, in this case, 26%? Okay, I haven't tested all the way to 26. I've tested up to 20%. Or should we take a smaller buffer, maybe 1 or 2%? So what's the ideal here? So the backtest for that buffer goes from 0% all the way to 20 for the optimal moving averages, right? So for the 35 and 26. So this is what we get at when we look at that. So this is for the simple moving average, the 35-day simple moving average. On the x-axis, we've got the buffer, and on the y-axis, we've got the annualized performance. So for most buffers, we actually underperform having no buffer at all, right? But when we take a very tight buffer, so at around 1%, we can still perform even a little better. When we look at the exponential moving average, the buffer pretty much doesn't work, right? So maybe we could take 2.2%, but I think this is rather random fluctuation, right? We see this fluctuating somewhat. So I think a buffer actually really only makes sense with the simple moving average, and that's around 1%, maybe 1.2%. So when we include this buffer in the backtest and we both bet on rising prices as well as on falling prices, this is then the final performance we get. right? So even a little bit better than without any buffer. So what's the current situation here? Let's look at the current price. Currently, the one token is below both of those moving averages, but we are not that far off, right? So from the simple moving average, which works the best, so the green line over here, the 35-day, we are currently off only by 1.4%. So we are pretty much struggling now with getting bullish. If we are only, quote unquote, going to say 14.5 cents, then we would already be above that buffer. Then we would already be back into bullish territory again. So then we would have made a fake out over here. If we can't go up by that much, as in we can't close a day above that price, right? 14.5 cents, then it does look like we might fall further. At least that's what the backtest suggests, right? That's what the data, the statistics suggests. So we are pretty much fighting now. I think if you are considering speculating in Harmony One, right? If you are considering not being exposed to these kinds of moves and you want to time the market somewhat, then it probably makes sense to wait just a little bit more until getting invested. There's not a lot of harm in just waiting for this, and the data does suggest that these kind of signals might work. Now, if you're interested in downloading this Excel sheet yourself, right? If you want to make these kind of backtests yourself, there is some kind of automation in here, right? So when you want to backtest this, for example, without shorting and maybe without any buffer, maybe you've got more transaction fee, maybe you only trade in a decentralized way. You want to do something like this and then want to find out, okay, what's actually in that case the best simple and exponential moving average. You can do this with this sheet, right? So there's a macro in here, this flickers a little bit and it takes maybe like 10 or 20 seconds until this is run. But then you get all the results with your modified input. So that might be helpful. So if you want to download that sheet, you can simply go here to the premium membership in the statistics library. There you see a download for all of these different Excel sheets. There's also tutorials on how to actually build those, right? Like video tutorials that explain all of this. And of course, we can't track all of these moving averages all the time, right? We have to look at all of those charts. So instead, I have built this premium alerts channel. So a channel that always sends automatic messages whenever important moving averages get crossed. So if you want to find out more, simply check this out. Thebitcoinstrategy.com is the link. It's in the video description. It's currently $49 US per month, or if you decide to sign up yearly, you get 2 months for free. I will, of course, continue to publish still free content here on YouTube, so don't forget to subscribe. There's around 1 new video every day. And if you're interested in my first impressions of using the Harmony One blockchain, you definitely don't want to miss out this video over here. It was quite an experience, and judging from the comments below that video, I wasn't the only one who faced something like this. So that's more of a fundamental look on this. It's less quant-based. A lot of value over there. You don't want to miss this. So see you in that video, and thanks for watching this one.